Hi. Let's learn about the Federal Unemployment Tax Act, FUTA, and how to calculate FUTA liability. Today, we will talk about the Federal Unemployment Tax Act is a federal law that imposes a payroll tax on most employers. The money raised through FUTA is allocated to state unemployment insurance agencies, which fund unemployment benefits for individuals who are out of work. FUTA taxes are only paid by employers, which means individual taxpayers are not responsible to pay them. The FUTA tax rate is 6% and only applies to a certain dollar figure paid to employees during the year. A company's FUTA tax liability is fairly straightforward to calculate. A company is subject to FUTA taxes on the first $7,000 of payments made to an employee excluding exempt payments. The FUTA tax rate is 6%, and employers often receive a credit of up to 5.4% against this tax. For example, if employee A was paid $10,000 in wages subject to FUTA taxes while employee B was paid $5,000 in wages subject to FUTA taxes, both in the first quarter. Regarding employee A, only the first $7,000 of wages per quarter are subject to the tax. Therefore, the tax liability would be $720. The company may be eligible for a tax credit of $648. If this is the case, the company would only owe $72. FUTA is a federal law that raises revenue to administer unemployment insurance and job service programs in every state. The funds in the account are used for unemployment compensation payments to workers who have lost their jobs. Although the amount of the FUTA payroll tax is based on employees' wages, it is imposed on employers only, not their employees. Wages that an employer pays to their spouse, a child under the age of 21, or parents do not count as FUTA wages. Payments such as fringe benefits, group term life insurance benefits, and employer contributions to employee retirement accounts are not included in the tax calculation for the federal unemployment tax. Form 940 can be amended for a previous year, and the IRS requires using the subsequent year to reflect the change. Various authorized personnel are allowed to sign Form 940 and remit the reporting of FUTA taxes. The reporting requirements for FUTA vary on the underlying entity that is remitting the taxes to the IRS. There are different reporting requirements for various types of entities or employers, including businesses, household employers, agricultural employers, and other employers. There's two components to FUTA: depositing FUTA taxes and filing the appropriate tax form. Companies that owe $500 or more of FUTA in a calendar year must make at least one quarterly payment. The IRS permits any single quarterly tax liability of less than $500 to be rolled to the next period. FUTA must usually be deposited at the end of the month subsequent to quarter end. The tax form is often due in full early in the calendar year. Many states collect an additional unemployment tax from employers as per the State Unemployment Tax Act. Paying SUTA taxes can lessen the burden of FUTA taxes. While FUTA is used to fund unemployment benefits, Federal Insurance Contribution Act taxes are different in several ways. FICA taxes are paid by both the employer and the employee and are used to provide Social Security and Medicare benefits. FUTA stands for Federal Unemployment Tax Act. The law imposes a payroll tax on employers to fund unemployment programs in the United States. A company is usually responsible for a tax of 6% on every employee's wages up to $7,000 per year. A company may often be eligible to receive a credit of up to 5.4%. FUTA and SUTA are essentially the same type of payroll tax used to fund government unemployment programs. However, FUTA is assessed at the federal level, while SUTA is assessed at the state level. FUTA is a payroll tax implemented on just an employer to help fund federal unemployment programs. FICA is a payroll tax implemented on both the employer and employee that provides funding for Medicare and Social Security. Most businesses are subject to FUTA if they have employees. If a company paid wages of more than $1,500 to employees in any calendar quarter during the year, they are subject to FUTA. Yes, FUTA is paid for by the employer. Unlike other payroll taxes, FUTA is not deducted from an employee's paycheck, and all tax liability for FUTA resides with the employer. Here are 5 key takeaways. 1. The Federal Unemployment Tax Act is legislation that imposes a payroll tax on any business with employees. The revenue raised is used to fund unemployment benefits. 2. The FUTA tax rate is 6% of the first $7,000 paid to each employee annually. 3. FUTA taxes are only imposed on employers even though they is based on employees' wages. 4. FUTA and SUTA are similar taxes just imposed on different levels of government, while FUTA and FICA fund entirely different programs by charging different individuals. 5. Employers who also pay their state unemployment insurance can receive a federal tax credit of up to 5.4%, resulting in an effective FUTA tax rate of 0.6%. Hope this would help. Thanks for watching.